What's up, Professor?
All right, we are recording, and we are now going to talk about Chapter 9, Long-Term Liabilities. Okay, so Chapter 8, we covered our short-term liabilities, so now we're going to talk about our long-term liabilities. If you look at Apple's 10K, from their most recent 10K, you can see that their long-term liabilities are $142 billion, right? And by long-term, what we mean is 12 months. So $142 billion that they owe, which is term debt and other stuff. Thanks for being so descriptive, Apple. This is the money that they don't have to pay more than 12 months down the road. Now, I wanted to show you all something. Let's see. It's always something with this. Let's see if I can get this to load. Okay. So we know assets equals liabilities plus owner's equity, right? And so if we looked at Apple's 10K, right, they owe $248 billion is what they owed, right? Of which 142 billion was long-term, the other 102 was short-term. Their total assets was 338 billion, which means what they really own, right? What the owners own of that 338 billion is $90 billion. But when we break this down, like, what are these assets made up of, right? They have 844 million in cash. They also had short-term investments of 51,713 million, and they have long-term investments they don't plan to use, right, or access in the next 12 months of 105,341 million. So just in their cash and investments, they have about $205 billion. So if they have $205 billion in cash and investments, why do they have $142 billion in long-term liabilities? It's a question.
He wants you to answer.
Oh, you want me to answer? I want you all to answer.
Can you please repeat it?
Yeah, so if they have $248 billion in cash and investments, why would they still have 142 billion in long-term liabilities? Why don't they just take that money that they have and pay off their liabilities and not have to owe anybody any money?
Well, you don't really need to pay off your liabilities early.
Does it have to do with like building credit or something.
Good. Adrian, you want to say something?
Does it just give them access to more cash, right, through lines of credit? They're kind of just like, I guess, using the full amount of liquidity they can get by taking on liabilities.
That's right. Yeah, so it's a little different if you're an individual, right? But as a business, but even partly as an individual, right? I'll just talk about myself as an individual. I would rather use Brad's $100 to go buy my groceries for this week than spend my own $100. Particularly if Brad's going to say, here, Eric, here's $100 so that you can go and buy your groceries. Pay me back next year. I'm only going to charge you 1% interest. I can take my $100 and go earn 2 or 3% interest, right? And use Brad's money instead. So that's how companies are operating. They'd rather, if they can find a way to be more effective, right? So from Apple's perspective, their investments are earning more than what they have to pay in interest on the loans. So it makes sense to what Brad was saying, what Justin was saying, to use someone else's money if you can hold on to your cash and use it to be more profitable. Questions? All right, so we're going to talk about 3 types of long-term liabilities: notes payable, bond liabilities, and leases. After we talk about each one of these, we're going to go into some breakout rooms and you all get to work on a problem. So let's talk about let's first talk about notes payable. So notes payable, so we talk about the difference between accounts payable and notes payable. Accounts payable is so for something that's kind of normal operating business. You're buying inventory, you owe your utilities, you owe consulting fees, right? So something that's more short-term in nature. Notes payable, think about, I've signed a contract, an agreement that said, I'm going to pay you back the sum of money over an extended period of time, usually more than a year. What's really important with notes payable is, so let me step back. When you borrow money, you have to pay back 2 things. You have to pay the money that you borrowed. It's called the principal. You also have to pay interest. Okay? Interest is an expense. That's the cost of borrowing money. Okay? Brad loaned me $100. I have to pay back $101. That $1 would be the interest. That's the cost of me borrowing Brad's money. So with in accounting, we only record the principal as the liability. Okay. So if Brad says, here's $100, you don't have to pay me back until a year from now, what shows up on my liabilities is the $100, the principal balance. That $1 that's an expense, that gets recorded as it's being used, right? So if that's going to be over a 12-month period, that's going to cost me about 8 cents every month to be borrowing that. Wait, am I doing the math right? 80 cents every month to be, you know what I'm talking about. 1/12 of $1. Yeah, 8 cents. 8 cents a month to borrow that money. So that cost is what gets recorded on the income statement as it's being incurred. Are there questions about that? Seeing none, hearing none. So there's 2 ways that we can record interest. One's called the simple method. One's called the compounding method. Okay. So let's talk about the simple method and what that looks like in terms of journal entries. So let's see here. Let's say we've got I went too far. Here we go. We've got a $6 million loan for 5 years. Okay. The interest is paid monthly, and the date of the loan is November 1st of 2017. So everyone do me a favor, get your phone or get your piece of paper, okay, and write down or take a picture of $6 million loan, 5 years, 5% annual interest paid monthly, and the date of the loan is 1st, 2017.
And this is doing it the simple method way you said?
Yes, we're going to look at journal entries using the simple method. So I'm going to switch over to an Excel spreadsheet so that we can type in what the journal entries would look like.
How do you do the simple method?
I'm going to show you.
Okay.
So you all got this information down? All right. So let's see here. Let me share. So it was on November 1st of 2017. Okay. We borrowed $6 million in cash, right? So we would increase our cash, debit cash, for $6 million. For our credit, we would credit notes payable. Okay. But here's where I want you all to be careful, right? So we've got notes payable current, and then we have notes payable long-term. Okay. The current portion is the principal balance that's going to be due within the next 12 months. Okay. So if we took that $6 million and divided it by 5 years, how much are we going to owe in the next 12 months or in the next year?
Would it be 6 million divided by 5?
Yes, it would be.
Got 1.2.
$1.2 million is what we owe in the next year. Okay. The difference is what we owe. That's the difference between, what's the difference? Between the $6 million and the 1.2 million that's due current. Questions? So then let's look at what our first payment looks like on 12/1/2017, right? 30 days later, we have to make our first payment, right? So we're going to credit cash. And how much are we going to owe using the simple method, when we use the simple interest method, you just take the balance of 6 million and you multiply it by the interest rate, 0.5%. Oh, 5.5%. But remember, because 5% is an annual interest rate, we're going to divide that by 12 and then multiply that by 1 month. By 12 months. All right, so and then we're only doing it for 1 month, so we multiply it by 1.
25,000.
6 million is what you get?
25,000 for 1 month.
25,000 for 1 month. I'll have something bigger than that.
I think it's 250,000.
Yeah,
It's 25,000.
yeah, that's what I said. Isn't that what I said?
Oh, sorry. Yeah, that is what you said.
Okay.
That's not the number I was trying to find. That's our interest expense. Gave you all a great explanation for interest expense.
Oh,
So we owe $25,000 in interest. Thank you. We also have to pay on the principal balance. So how much do we owe on the principal?
500,000? No.
So we owe $6 million, and we're going to pay that over 5 years.
100,000?
Exactly. Take the 6 million, and you divide it by. We could just divide it by 60 months, right? Because we're paying on it every month. 5 years. 5 times 12, 60.
why would that be evaluated as a note payable current instead of just the principal value?
Remember, this 1.2 million represents the principal.
Okay.
So every time we make a payment, we're reducing the principal balance. So the cash that we have to pay is 125,000. When we're making a payment on, when we're paying off a loan, we're paying the principal and the interest.
Mom.
Questions?
How come you multiply it by 5 by 12 again?
It's for 5 years, 5-year term, and we're paying it every month.
Okay.
Here, so now let's look at what happens when we get to 12/31. Oh wait, no. We got to do one more thing on December 1st, 2017, because if we were to look at our if we were to look at our T account, right? Our T account would say for current liabilities. Let me just do a quick share here. All right, we got current liabilities, notes payable, current, and then we had notes payable long term. Current was 1.2 million. Long term was 4.8 million. And then we did this journal entry on December 1st for 100.
I hate this.
So now it's showing that we owe
Soy ice cream and soy ice cream bars.
Where did you go?
1.1 million.
And you didn't buy other stuff?
Can somebody mute their mic? I can't hear the professor. Thanks.
So 1.1 million. But how much do we owe in the next 12 months when we get to December 1st? How much do we owe?
Do we owe
Principal over the next 12 months? I'm sorry?
Wait, for 12-1?
As of December 1st, how much do we owe over the next 12 months?
1.1 million.
How much are we paying every month
125,000?
in principal?
Oh, just 100,000.
100,000. Do we have to pay that 100,000 for the next 12 months? Really for the next 69 months, 59 months. So over the next 12 months, we owe
1.1 million?
well, I'm getting 1.2 million. Right? When we get to the next month, right? Remember, it's always looking at the next 12 months is what your current liability is. So within the next 12 months, we're going to have to pay $100,000 every month. Oh, I'm so glad I can't see the blank stares on your faces right now.
Yeah, definitely lost me.
So the current liability is always what's due in the next 12 months.
So that
So
should look like that for the whole 5 years, right? Because we're gonna owe 1.2 million a year for the whole 5 years, and we're gonna pay 100,000 every month for the entirety of the note.
that is correct. It will look like that for the whole entirety of the 5 years. What's going to drop every year is going to be this long-term notes, because now I only owe 4.7 million beyond the next 12 months.
Okay, and the long term is like, right? Okay, it's not really the principal, is it? It's just long term.
It's still the principal, but it's the principal that's due more than 12 months from now.
Okay.
So I said all that to say, we go back to our journal entry. On 12/1, we also have to do a journal entry where we debit notes payable long-term for 100,000, and we credit notes payable current for 100,000, so that we keep that current, the notes payable current account at $1.2 million, the amount that we owe over the next 12 months.
So it's kind of just looking from long term to current as you go through the years, right?
Yes.
Question, Mr. Bell, for the notes payable current on the first one, the 12/1. Your explanation 6 million divided by 60 months and then 5 times 12. What do you mean by that? Like,
So 60 months is, probably should move this right here. Okay. So it's 5 years, and there's 12 months in a year.
oh, and that's how you got the 60.
Yeah. That's how we got the 60 months.
Okay.
So then when we get to December 31st of 2017, right, we're at the end of the year. We have to record revenue when earned, expenses when used. So even though we haven't paid for interest that we owe, right, this is the accrual method of accounting, we've incurred another $25,000 in interest. 6 million times the 5% divided by 12. But we didn't pay it yet, so instead of recording a credit to cash, we record a credit to interest payable for $25,000. So now we're talking about the accrual method of accounting, where we're recording expenses when used, right? And this is that accrued expense column. If you think about that four quadrant from chapter 3, we'll record the expense, record the liability. And then let's say on January 2nd of 2018, we come back to work, we make our payment, right? We know we're paying cash of $125,000. We know we're paying principal of $100,000. Oh, not $1 million. And our credit goes to interest payable, because we're paying off this interest that was due 2 days earlier. Other thing that we do on 1/2/2018 is we reclass or move money from current to long-term. So the same journal entry we did right here, we do that same journal entry again right here.
And you said we do that because you always want to keep your notes payable current at 1.2 million.
Yes. You want to keep your notes. Can I say that? Can I answer that? Can I answer that question slightly differently? You want to keep your current notes payable equal to the amount of principal that you owe over the next month. So I hope you all feel good about this, because this is the simple method. And now we're going to talk about the compounding method. And when we use the simple method, what we were just doing, we take the principal, multiply it by the interest rate.
This is the compounding method or the simple method?
This is a simple method.
Okay.
And that gives us our interest expense. So that's what we were doing. We were taking $6 million, the amount that we borrowed, multiplying it by 5%, right? And then that's telling us how much we owe in interest each year. Thankfully, you guys, that is not how it works in real life. Okay? So when we're using the compounding interest method, the interest rate, in order to get our interest expense, we multiply the interest rate by the remaining principal balance. So in other words, We're not going to say you borrowed $6 million 2 years ago, so we're still charging you $25,000 a month on that. You go, no, I've been paying on the principal. Every time I pay on the principal, then the amount of money that I still owe you is less. Therefore, the interest that I owe you should go down as well. Just want to pause for a second and see if you have questions on that concept.
So as our long-term liabilities go down, would that be decreasing the remaining principal balance?
Sorry, I was reading the chat. Ask me that question again, Bradley.
Oh, sorry about that. So as we pay off the long-term notes payable, that would be decreasing the remaining principal balance, right?
Yes.
Okay.
Other questions? So I'm going to go back to your question, Evan. And this doesn't matter if we're using the simple method or the compounding method to answer your question, Evan, that's in the chat room if you guys want to see it. Go back to here.
Are you gonna do an example with the compound method?
I am, yes. So the reason why we're doing this journal entry here, okay, and here, is because the amount that is current represents the amount of principal that we have to pay over the next 12 months. So in this example, since we're paying $100,000 in principal every month, right, and for the next 60 months, that means at any given point in time, we're going to owe $1.2 million in principal over the next 12 months until we get to like month 49, and then we only owe 11 months, and then month 50, and then we only owe 10 months, right? So it's the only way, because when we're in that last year when those payable current starts to go down. So this concept of compounding interest, okay? So we don't do that by hand, right? Unless you're taking like a business calculus class. And if you are, God bless you. Sorry, I was just looking at a chat. So can you all see this amortization schedule? I think you can. So if you look on Canvas, I have posted an amortization schedule. Okay? So this is how your loans actually work. Okay? So every company is using this. So I went into Microsoft Excel and I just created this table, and I'm giving it to you so that once this class is over, can you guys see this? I don't think so.
No.
Let's see here.
We're still looking at the Excel sheet.
Let me share and let's start over. All right, can you see that now?
Yes.
Yes.
All right. So I gave this to you. Once this class is over, if you have an outstanding loan, you can go do your own analysis to see how much do I owe, and how long is it take to pay it off and things like that. Okay. So the way this works just is only enter things in the yellow. Okay, everything else is formula driven, and I'm scared to touch it myself. So here, let's go back to our example. Right, it was a $6 million loan, and it was a 5% interest rate. And this is set up to talk about months. So if it was for, was it 5%? Yeah, if it was for 5 years, right, and there's 12 months in a year, 5 times 12 is 60, right? Or you can just do equals 5 times 12, 60 months. And then it's going to calculate for you what your actual payment would be for this loan. So your actual payment would not be $125,000 each month for the next 60 months. It would be $113,220.40. And then you just drop in the date, 11/1/17. And then I've got it so that it populates out for the next however many years your loan is. Okay. All this is formula. Okay. But I want you to see something, right? So this is your beginning balance right here. Can you guys see my mouse?
Yes.
Okay. So then when you make your first payment of $113,227.40, okay, of that amount, you're going to pay $25,000 in interest, right? That's the $6 million times the 5% divided by 12. The rest of that is going to go towards your principal, which means the amount that you now owe in principal becomes $5.9 million and change. So the next month when you make $113,000, or when you make a $113,000 payment, you're going to pay interest on 5.9591177.6 times 5% interest divided by 12. It's going to be slightly less, $24,632.39. So your payment's going to go first to interest, then the rest goes to principal. Okay. And you can see that that keeps happening all the way until you get somewhere around here. Where is it at with? Oh, it never really flips on this one. But you can see that they're always going to make you pay the interest first, and then the difference goes down to your principal balance. Okay. So if you have a car loan, can I just digress for a little bit and say you're thinking about taking out a car loan, right? And you want a $25,000 car loan, and they're telling you the interest rate's going to be 6%, and it's going to be for 72 months. Okay. It's going to be $414.32. It's going to be your monthly payment. Okay. If you say, I want to finish that up in 5 years, not 6, 60 months, it'll make your payment go up to $483.32. And then you can see the amount that's going first to interest, then to principal. Okay. And you can see how that kind of works its way out, where you're paying less and less in interest as it goes down. Any questions on that? We're going to talk about it. We'll get back to accounting. All right. But any questions on this amortization schedule and how you can use it, like for real, for real?
How would this work if the interest rate like varies?
This right here would not, it wouldn't work with this spreadsheet because it's too simple. But if you have a variable interest rate, I'd probably just duplicate this. I'd make multiple versions of this table, the sheet, and then it's at 5% for the first 3 months, right? And then, or for the first year, and then when it changes to 4.75, then I would take the remaining amount that I owe. I'd get a new spreadsheet, and I'd just plug that remaining amount in, the interest rate, the remaining months, the date, and then I'd start using that table. But someone better than me with using Excel would even find a more slicker way to do that. By the way, I don't consider myself to be good at Excel, and I was able to do this. So let's look at what the journal entries would look like if we were doing this using the compounding interest method. Okay, so great news, guys. The journal entry itself doesn't change. The only thing that's going to change is our numbers. Okay. So we still borrowed $6 million in cash. Okay. But the current portion of just the principal that we're going to pay is going to be, let's go to the window, let's go here. The principal amount that we owe over the next 12 months. And I don't know if you know this, but if you just click on a Excel cell, and then you press your shift button, and you start typing down, it'll capture all this. And then right down here, it tells me I've got 12 things, and it tells me the amount of all 12 of those. Over the next 12 months, I owe $1,083,331. No one say anything. I have to remember that number in my head. $1,083,331. $1,083,331. That is the principal due in the next 12 months. And the rest of the principal is going to be due more than 12 months from now, right? So it's the difference between this and this.
Wait, Professor,
491.
where are you typing this again?
Where am I typing this?
The numbers that you just mentioned.
Oh, can you not see my screen? Oh, you can't see my screen. Sorry, guys. Typing it here.
Give me a second to catch up on this.
So we borrowed $6 million in cash, right? That didn't change. The only thing that's changing are going to be our numbers that were here. These journal entries are not going to change. Okay. So 6 million, current portion is 1.083, and then 4916669 is the difference. And that 496,669 is coming from
Is our principal due in the next 12 months different? Oh, so
go ahead.
I don't know. Maybe I'm
Principal
beyond lost. Why in the world is the current different than it was before?
Because remember the current portion, what goes in the current portion, and this is what you guys should write down. What goes in the current portion is the amount of principal that's going to be paid over the next 12 months. So if I have, here we go. So you guys are seeing the amortization schedule?
Can you just repeat what you said one more time?
the amount of principal, or the amount of principal to be paid over the next 12 months is what gets recorded as a current portion of notes payable.
Okay, but why is it different than it was in the simple example, though? Did we do a different operation? I just didn't see.
The simple operation is not, when we did the simple method, that's not really how loans work. You're not going to pay 5% interest, $25,000 a month for the next 60 months. You're going to pay, using the compounding method, $25,000 the first month, $24,000 the next month, and it's just going to keep going down and down and down. Can you guys all see the compound schedule that's in?
Yeah.
Yeah,
Say
I
yes.
see it.
Yeah. I think what he's trying to ask though is that for the simple method to get our first note payable current, we did 6 million divided by 5 and got the 1.2 million. And so we're just curious on how you got 1.083
He has
million.
this table in front of him, but I don't have a table in front of me. Are we gonna always have this table?
Are you going to always have, yes, so this table that's in front of you is available on Canvas. You will always have this table in front of you.
I think too, like the difference there, right, is between simple and compounding interest. The interest compounds monthly. That's why it's not an even payment every 12 months, because as you're paying the interest off, it's compounding on the new principal that's being generated.
Correct. So someone was also asking, how do we get the 1,083,000?
Yeah, if you wouldn't mind going over
My
that
question
again.
the whole time.
So the 1 million, so what goes in the current portion is the 12 months of principal payments. Okay. So with this schedule, I can just go right here, click here, shift, oh, not that. Okay. Go down, capture 12 months of activity. Okay. So I don't know if you can see my, can you see my mouse down here, circling 12 months?
Yes.
Okay. So the sum of everything that's added up for the next 12 months is $1,083,331.48. This number right here.
Oh, okay, for sure.
And then, so that's the number that goes in the current portion. What's due over the next, after the next 12 months, the next 48 months is this number right here, 4.916669.
How would we find that if we don't have this table?
He said it was on Canvas.
You cannot do this without a table. Well, I'm not going to say that. You have to do some algebra, calculus type stuff to figure this out.
Yeah,
so
that's why you have
arithmetic sequence. So you'd have to calculate each one before you find that number after 12 months. So it only makes it 10 times more difficult without a table. But
So
yeah.
when it comes to being asked about this on a test or homework or anything, we have to use this to figure it out.
Oh, sorry. I wasn't clear. You're not going to be tested on compounding interest.
What the heck? Okay.
What I want you guys to understand is, one, how the journal entries work. And I want you to understand how, I want you to understand the difference between current and long-term. And I want you to understand the only thing that gets recorded as a liability is the principal balance. So that's why we can use the simple method so that you can practice the journal entries. But I would be doing a disservice if I don't tell you how it really works. And so how it really works is we have these ugly numbers right here. But the ugly numbers don't really matter because the journal entry is going to be the same. The same one that we were doing when we were on the, when we did the simple method. The journal entries are still the same, right? We just have different numbers. So here, we know our cash that we're going to pay is 113,227, right, every month. And I'm just going to flip back. Oh, and then in the first month, our interest expense was 25,000. And so the amount of principal is this minus this. And if you go back to here,
It says the same thing.
you'll see the 25,000 right here, the 88,227 right here. So you're just taking this information, credit cash. This is your credit to cash. This is your debit to short term, to notes payable, short term. And this is your debit to interest.
So yeah, what's the distinguishing factor between long-term notes payable and short-term notes, or current and long-term notes payable?
Great question. What's the difference between current and long-term notes payable?
Current is within 12 months, and then long-term is more than a year, right?
That's right. Other questions? Did that answer your question?
Yes.
Andrew?
Yes.
So then I would take these same, so the other thing that we have to be mindful of is, remember, so actually what we just talked about, current is within 12 weeks, what's going to be paid the next 12 months, right? So here, it was 1083, but now we've paid this 88,000. So the next 12 months we owe 1087. Okay, which means that I have to move this number here, 92,741, from long-term to current. So this would be 92,741, moving from current to long-term. And then I would, so that would be December 1st. When I get to December 31st, I would have to record the interest that's now owed for the next month, which was 24,632.39. We'll just use round dollars. 24,632. This is the accrual method of accounting. And then when I get to January 2nd, I'm still paying 113,227. 24,632 is my interest that I'm paying. The difference goes to my principal. This minus this. And then I have to move more from my long-term to my current, because my current always has to represent 12 months of activity. It was 93,128. 93.
So you're paying, okay, so you're paying just the same amount every single month. That is the $113,227. But the way you get there changes each time, correct?
Correct.
Okay. Okay.
So every month, this number is going to go down. This number is going to go up.
Sorry, how did you get the 92,000 again?
This number here?
Yeah.
So this 92 is coming from the amortization schedule.
Okay.
Which is right here.
So you have to make 2 journal entries each time you make a payment. Is that correct too?
Yes.
Okay.
All right. Woof. Let us practice. So I'm going to put you guys in some breakout rooms, and I want you to write 4 journal entries out using the simple interest method. Okay, we're not going to use the compounding. This, again, once you understand how the journal entries work, we're just changing numbers. We'll just keep it simple. It's a $3 million loan for 10 years, 6% annual interest paid monthly. Okay. February 1st, 2018. What's the journal entry on the date of the loan? What's the journal entry on the first payment date? That's the second one. What's the journal entry on March 31st when they get to their first financial statement on the accrual basis of accounting? And then what's the journal entry on the second payment date? Okay, April 1st of the next period. Okay. So take a picture of this. And does everyone have a picture of this? Thumbs up.
Yeah, I got my photo.
Everyone's got a picture? So we're going to go to our breakout rooms, take maybe, I don't know, 10 minutes, work on this. And if you have questions, you can always invite me into your room. Okay, so you can now join your breakout rooms. Jeremy, you see which breakout room you're in? And Romina? All right, I think people are all coming back. How many of you were able to get the correct answer?
I believe so.
Does anyone have a screen share where you can show us the answer that your group came up with? Does anyone have their answers on a screen share?
Nope, nope.
I didn't know. So I know we're all adapting to this new way of learning. And one of the coolest things that Zoom has, which I didn't realize until about 2 weeks ago, is this concept to have breakout rooms, to get into smaller groups and to work together. Once you're in those smaller groups, the purpose is really to have interaction. And so I encourage you all to do the work on a screen share, maybe do it in Excel, and just be typing it. And as everyone's talking, I guess the one person that's typing is, no one's at a disadvantage, because if you're typing it in, then you have the notes on your computer that you can write down later, and everyone else could be writing. But really take these opportunities to just take all the technology that you have and work together in these smaller groups. Because I'm going to show you what the answer is. I know that it's not going to be as effective as if you all were working in smaller groups and able to ask questions and say, wait, how'd you get that number? Where'd that come from? I got something different, etc. So if I were to go back to this screen share, let's see here. Stop share. Okay. All right. Go here. Share. And I believe you all can see my journal entries. So the journal entries, the accounts don't change. The only thing that's changing are the numbers. So what did you guys get on the dates? So the date was, what was the date? Was it February 1st?
Correct. February 1st.
How much cash did they borrow?
3 million.
How much do they owe within the next 12 months?
300,000.
How much do they owe
Long term,
after
2,700,000.
Questions? Now, would you agree with me that it works a lot better when everyone can kind of see the same thing that's being written?
Yes.
Yeah, definitely.
Oh, good. Yeah. So use that share feature, you know. Hey, you know, the other thing you can do, you didn't hear it from me, you can get in those small groups and you can just start talking. Hey, how you guys going? How's it feeling? What's going on? How's it, you know, where are you getting exercise? Or where are you buying your toilet paper from? That's 10 minutes of good conversation. Anyway. How much is interest on March 1st of 2018?
I got 15,000 for the interest expense.
That's what I got too.
Yep.
15,000. I assume 3 million times 6%,
Mm-hmm.
and then divided that by 12.
Yep.
Excellent. How much principal are they paying?
25,000.
And that is the 3 million, using the simple method, 3 million divided by, I guess it's 120 months. It's a 10-year loan, 10 times 12 months.
Yep.
So that means the cash is $40,000. Other journal entry. This is what the last group breakout room I was in was asking. I think about this question.
Oh, yeah.
So we want to make sure that our current portion always represents 12 months of principal that needs to be paid, right? So because we just reduced it by 25,000, we need to increase it by 25,000. And we'll reduce our long-term portion.
So for that one, we would just use the same values from the previous journal entry, yeah?
For the principal portion.
Yeah.
Yes.
All right, right on.
Is this 3/1/18 or 3/31/18?
This is still on 3/1/18.
We're doing two. We have to do two entries.
Yes,
Okay.
because once you move money out of the current portion, you always want that current portion to represent. Go ahead.
Sorry, you asked for 4 journal entries. And then I remember the example had more than that, which was 5. And so I think we skipped one.
Oh,
for
so look,
this
if you want 4 journal entries, I'll just delete that, and then all this happened on 3/1. Okay. This is all part of one journal entry. Interest expense at 3/31, accrual basis of accounting would be another 15,000. And we recorded liability for 15,000. The same formula here. And then, yes.
So for the 3/1/2018, we're gonna have 2 notes payable current.
Yes. You mean this one here
and
this one here?
Yeah.
Yes.
Okay.
Because what's happening, Samantha,
Yeah.
is and everyone just kind of step away from the numbers a little bit. We want to have 12 months of principal balance due in that current liability. So at the end of the month, we're paying some of that off, right? So now we only have 11 months of activity, or of 11 months of principal due. But we want it to be 12 months of principal due. So we add another month back in. So we're taking something out, debit the liability. We're adding something in, credit the liability. And then on the following day, when we make another payment, right, we're paying our principal of 25,000. We're paying off our liability of 15,000, costing us 40,000. And then the other thing that we're doing, so we're just talking about, Samantha, is we're adding to our current liability so that it represents 12 months of payment. Okay, so that would be another 25,000.
Oh, okay, I see. Thank you.
Of course. What other questions do you have?
Would it be technically wrong if I'm missing the journal entry for the notes payable long-term, notes payable current?
Yes. because now what's sitting in your current liabilities is only 11 months of payment due. Yeah, that would be
How come?
that would be very misleading.
Question was on how come on 3-1 it's an interest expense, but on 4-1 it's interest payable?
I had that same question.
All right. So on 331, this is the accrual basis of accounting. Record expenses when used. So we've got to the end of the month, and we've now borrowed that money another 30 days. So we have to record the expense on that 30 days, for that 30 days. On the next, I'll slow down. On the very next day, when we actually pay the cash, we're paying cash for interest that we've already used but have not paid.
And it should follow this format monthly, right? So you pay the principal and the interest, then you adjust your T accounts, and then you record the expenses.
Yes.
Okay.
Yep. It's just what it looks like every month. The formatting. So obviously in the real world, that number is going to be different. Let me pause for a second and see what questions you have. Has anyone been able to download the amortization schedule?
Is it on Canvas?
Anyone done that yet? Yes.
I tried it.
Yeah, I got it from Canvas.
I have a question, Mr. Bill. The first journal entry for April 1st, what is that recording again? Is that just recording like the interest that we're paying?
Would anybody like to answer that
Record
question?
the purchase of the notes payable or the acquisition of the loan, right?
I think he's talking about April 1st.
Yeah, the first journal entry on April 1st is recording. So notes payable current, that's you paying off your principal. Interest payable is you paying the interest, and then cash is what you're using to pay that.
Okay.
What's the difference? Hey, do you know what the difference between that interest payable, interest expenses on the 1st of May?
March.
Or March, my bad. Yeah, the 1st of March. I don't know why the 1st of March is an interest expense and the 1st of April is an interest payable, even though they're the same value.
Yeah, I don't know. The only time I understand the interest expense is when it lies on March 31st, because we're recording the expense when used at the end of every month.
Yeah, I got that.
I guess that's the same situation going on here. It's the end of that month, so we're recording that as an expense.
Yeah, I guess. So with the next entry, if there was another entry following that April 1st one, I guess it would become an expense again because now they're expensing it.
Yes. Yeah, like that'd be like April 31st, I think. It would look just like 3/31. Or yeah, 5/1.
Yeah, makes sense.
So 5/1 would look like would look like this.
Okay, yeah. See, that's what I thought. If it just repeated itself.
And 6-1 would look like this. And then 630, right? And at the end of another period, we have to do this thing again.
So that little one is what takes place after like a 3-month like quarterly period.
Yes.
Okay, I got it.
Which means 7-1, 18 looks like 4-1. We're reducing our interest payable, not the expense.
Got it. Sounds good.
All right. Was anyone able? So I don't know. Was that Brad that said he downloaded the amortization schedule?
Yeah,
I
I
got
don't
it.
have it installed on my computer though, so I can't actually use it.
Is there anyone brave to share their screen and let's put in the example, but using real numbers? Let's find out what the real numbers are by plugging it into the amortization schedule. We'd like to.
For credit?
I'm sorry?
For extra credit?
Yeah, Madison, as soon as I get some extra credit, I'm going to start giving it out to everybody. Not there. I'm going to give y'all some of it. No, for pride.
Where did you find the
Purpose.
amortization schedule? I'll try and download it.
I've got it already if no one else wants to or can't get it.
All right, so I'm going to stop my share so that you can share your screen.
Is it up?
Yep, you can see it.
Okay, so loan amount was 3 million. Interest rate was 6%. So for the interest rate, should we put it as a decimal or 3% and it'll calculate correctly?
I think you just type in 6. Type in 6, see what happens.
Okay, yeah.
Yeah.
And then 10 years is 120 months. Okay. So for the first journal entry, if I'm not mistaken, the notes payable current, you're gonna get the principal for the first 12 months.
Mm-hmm. So if you just highlight 12 months, if you see at the very bottom, it's counting 8, 9, 10, 11, 12. You see that?
Yep.
And then so that total there's 225,817 rounded.
So that would be to the.
That would be the current. And then if you look at the ending balance, that 2774183. Go. Yep. That would be the long term.
Okay.
So actually, first, before we get to that level of detail, so in real life, right, the monthly payment is not $40,000 a month. It's $33,306.15. Right, so that's how we get that real number. And then someone said this. Someone said this on earlier. That 33,306. I think it was Andrew, is changing every month. How much goes to principal, how much goes to interest, right? And so it's a little more time consuming, right, when you use the amortization method. because you actually got to start typing out. You got to figure out it's going to be a different amount every month, but the journal entries remain the same. Okay. I'm going to stop sharing your screen now. No way.
Yep.
Thank you, sir. All right, we are up against it. What questions do you have?
So you said we're recording those interest expenses quarterly, right?
The interest expense gets recorded. Oh, the payable? Is that what you're referring to?
Yep.
Yeah, if we were doing it on the accrual basis of accounting at the end of every
period.
30 days, right? Yeah, at the end of every, not 30 days, at the end of every period, you want to make sure that you recorded your expenses when used, the revenue when earned.
Okay.